Welcome everyone to the fourth installment of TradeStone's Global Issues webinar series. We've got a full capacity crowd today for our session, Predicting Cotton Prices, the Experts Sound Off. My name is Tanya Stockbridge. I'm the Director of Marketing for TradeStone. And on the call with me today are Richard Hastings, a leading consumer strategist, and Nancy Marino, former chairman of the Cotton Board. Now, a year ago, cotton prices were 83 cents. 3 weeks ago, the average price was $2.02. We hit an all-time high on March 7th of $2.20, and as of yesterday, the closing price was $1.67. Richard and Nancy are going to share their predictions for what cotton prices will be end of year 2011 and 2012. We're going to end with that, so please stay tuned. All right, just before we get things started, just want to go over a few logistics. Please note that due to the large number of people we have on the call, the audio today is muted. Please use the question box to the right of your screen. If we're unable to get to your question, we will follow up with you when the webinar is over. Also note, we're going to be recording today's session, and we're going to make a copy of that recording available to you on request. And we'll also be uploading that to the TradeStone website in the next couple of days, so please keep an eye out for that. A quick note on the agenda, we're going to have each of our experts start by providing an overview on the current cotton situation for about 5 minutes. Then we're going to get into a live Q&A perspective where they'll have 2 minutes each to respond to one of the questions we pose to them. Following that, we're going to end with an open question and answer session for attendees. And then the last question that we're going to pose to our experts is going to be, tell us your predictions for cotton prices by the end of year of 2011 and 2012. So who is TradeStone and what do we do? TradeStone helps retailers and suppliers increase market share and improve margins through the use of merchandise lifecycle management solutions that unify the design, sourcing, ordering, and delivery of their private label and branded goods. TradeStone is one of the few software companies that is 100% focused on the retail industry. Retail and brands are definitely what we know. Now, as you can see, we work with top-tier retailers, helping them forecast and manage what they're going to need. They represent category leaders and hundreds of brands, both private label and global. Now, a quick note. Interestingly enough, TradeStone started preparing for the cotton crisis in 2004, making sure that our technology would be able to handle the issues that retailers and their suppliers would experience from a commodity shortage. Our CEO, Sue Welch, recently took us down memory lane in her blog, where in addition to sharing an interesting story about Larry Ellison, CEO of Oracle, she discussed how she and the exec team really got the impact that commodities would have in retail. And they built out the design of the product to address them. When the crisis happened last year, we were well prepared to help our customers expand their material management capabilities so they could pre-position raw materials, dynamically recast the impact on cost and time, and mitigate inflation. Today we're also working with them to do production forecasting. But we're going to get back to today's issue, so without further ado, let's meet our presenters. First we have Nancy Marino. Nancy served as former chairman emeritus of the Cotton Board. She is currently president of Leo North Consulting, which focuses on supply chain and retail, and she's held several senior level positions at retailers such as Hanes Branded Apparel, Sears, and Federated Department Stores. Nancy currently serves on the boards of the Retail Marketing Society, the Foundation of FIT, and she's also still currently a member of the Cotton Board. We welcome you, Nancy. Our next presenter, if you've turned on the nightly news, you've likely seen Richard Hastings. He's the go-to guy for when it comes to commenting on anything and everything impacting retail. He serves as consumer strategist at investment bank Global Hunter Securities, where he provides top-line views of major trends in the consumer universe, retailing, capital markets and forex, employment trends, and social media. Richard's also been following the cotton industry since 1997, so he is definitely very well versed on this topic. Now I'm just going to go ahead and give controls to Nancy and let her go ahead and take over.
Thank you, Tanya.
Excuse me, go to meeting.
Oh, Tanya, I don't know what happened.
Nancy, what I can do is I'll pull it up on my screen and I'll just run through. Oh, actually, there you go. You're up.
When you turned it over, it went over. Okay, good morning, everybody. Sorry about that little glitch. Thank you for joining us. Basically, before I start, I think it's important for us to look at the factors that impacted cotton prices as we look forward to the fourth quarter of 2011 and 2012. That's 2012 really looking to probably the first half of the year. The operative words recently used to describe today's market have been volatile, unpredictable, and historic. This is the perfect storm of supply and demand. There is not enough cotton in the world market, leading to cotton price explosion, as well as being impacted by logistics increased pricing, diminishing production capacity in China, and the fluctuating exchange rates against the dollar. With China and India's economies on fire, they really have impacted the demand of cotton, and it continues to remain strong. The balance of inventory has tightened and remains low. To add greater impact to the pricing pressures that we're seeing is the fact that the new-to-market cotton crop that we're all looking at, basically exportable in 2011, is pretty well sold out. I've been told that 95% of that crop has been committed. China continues to be the largest importer of cotton, as weather patterns are predicted to hurt their crop. But more importantly, the government guidelines are demanding greater acreage be given to agriculture and much less to cotton. We all know the impact India has made on the market with the restrictions on the export of yarn, and finally, investor interest in cotton fuels speculation and investment in cotton. Hopefully, there is a chance for some price easing, as significantly higher prices have resulted in a 15% increase in acreage planting. In this slide, there are a couple of little takeaways I just want to basically tell you about. The first is the fact that if we look at India, India had an exportable 26 billion bales. It's really projected this year to have a record crop of about 29 billion bales. The United States right now is forecasted to be about at 19 billion bales. And Pakistan, because of all the issues that we had last year with them, basically have planted their crops 3 months earlier, and it's looking at a record-breaking 19 or close to 11 million bales. The forecast for 2012 basically is to have a 7% increase in acreage planting, which hopefully will lead to about 9% in total crop increases. I keep getting asked about, who are the largest exporters of cotton, and this slide just gives you a global view of between 2009 and 2010 of the countries that are involved in the heavy export of cotton. The other thing I get asked for on a continual basis is to really illustrate the cotton calendar, because a lot of people don't understand the growth cycle, because it really is a 12-month planting. But this gives you the idea of what happens between the planting, the growth, the harvesting, and when new cotton crop comes to the market for mill delivery. The next slide I've just laid in to give you an idea of how the prices have increased. If you look at the cotton crop planting season, how cotton prices were increased as a result of a lack of supply. I mean, virtually just absolutely do not have the cotton in the pipeline to basically support the growth of the market. This is some fundamentals that I think are key takeaways for you. The first being that the beginning stocks continue to be low, but importantly, if you look at the ending stocks, they're projected to be up, and that's because the cotton crop coming in will be up in total about 9% on a world basis. The stock-to-use ratio is coming better into line from where it used to be, and that's good news. That's good to have happen to us. Until the cotton bubble actually bursts, it's going to be rough going for most apparel and textile firms. Most companies hedged margins as a percentage of the inventories were committed with cotton under $1 a pound. Many of the buyers and yourselves have been asking, why am I constantly getting price increases? It's for that very reason. As mills and vendors had to go to market to buy spot, the prices were changing on a daily basis, and that led to the continuous price quotations. What I think you need to do is focus on the spinners and fabric mills. They are the most vulnerable if they are not vertical and they have very little forward supply. There are instances of fabric shortages which basically has impacted production, which could lead to closures if factories have nothing to sew. A word of caution is that I think we all have to watch very closely and monitor production orders to ensure that we get a continuous flow of orders and that we don't get caught into any cancellations. We all know that Chinese imports will remain strong and will definitely keep the pressure on prices. It is also apparent that cash flow has to be shifted to secure fabric flow and mitigate risk for in the supply chain as you really try to protect your business. I know that shortening of lead times was the issue. Now you really have to look at how do I secure my cotton and my fabric flow to ensure I get delivery. As prices of cotton have continued to increase, other fibers have become more important because they have more value to the consumer, such as rayon and tencel. Cotton blends have come into play really to mitigate price because you're looking at more 60-40, with poly being about 40% cheaper than cotton. I think what you really have to watch as we go forward is consumer spending. How is she going to react? Textile import levels. What really happens if we have a major import impact to the supply chain and we don't have the cotton crop go forward that we're predicting? And as we look at the cotton planning, we've got a lot of forecasts in line, but what we don't know exactly at this point in time is what's going to happen with the weather patterns across the country or the nation, and what's going on right now with the Texas fires. In summary, we're looking at the predictability. Predictability is out of the market. The fundamental supply and demand has really tightened and will continue to tighten. Higher prices are going to be with us for a while, and basically you're all seeing it as prices are continue to be high as we go into the summer and fall season. There's some easing that we're looking at, but probably not until the beginning of 2012. A lot of market prices have factored into the anticipated increase of cotton, but again, as I said before, we don't know what's going on with the weather patterns. The strength of fiber prices across the market basically will remain strong, and more plantings this year may not result in more supply, as we said, because of the weather patterns or what's really going to happen as we go forward. Thank you.
Great. Thanks very much, Nancy. Now I'm going to go ahead and give controls over to Richard and let him kick things off.
Great. Thank you, Tanya. Let me make sure that my screen's going to show up. Bear with me 1 second, everybody. We should be good to go. Let's see if we can switch over. That doesn't look like where we want to be. And I think we've got it now. And we'll switch over there. Hang in there. All righty. We should be good, Tanya.
Yep, we're good.
Great. All right. When we did the first cotton webinar in November last year, prices had been threatening the $1.50 per pound level and then started to come back down. I was asked on the phone call where I expected prices to go. I was a little bit uncertain, but when I was asked, I suggested that they would trend back towards $1.50 after a brief correction. Let me make sure that this stops. Excuse me. Now getting back to the prices, once they started to go back up towards $1.50, it looked like things continued to trend rather exponentially well into an unusual pattern for that time of the year. If you look at Nancy's chart about the different periods of the year that have to do with planting and harvesting, the different contract prices will reflect those major patterns during the year. And last year, you could see that the contract prices in the spot market started to defy that ordinary historical pattern of prices in the beginning, middle, and the end of the year. So we're definitely in a new territory. The dollar's weakness has a little bit of an impact there, but it's just simply insufficient to explain what's going on. Now, let me just read what we've got over here on the slide. Global plantings of cotton have increased this year, but global demand and an obviously weak crop in the U.S. later this year are going to maintain pressure on ending world inventories, ending stocks of cotton. China's internal consumer spending is intensifying, and that's adding more pressure. Tanya, we're getting a message that, are we back?
No, yeah, we can see you, Richard.
Okay, fine. China's internal consumer spending is intensifying, adding more pressure to global demand. First quarter consumer spending in China increased by 16.3%, and in March alone, it was up 17.4% year over year. Those are very big numbers. Garment sales, they used the phrase garment, up by 22.3% in the quarter year over year. China's estimated internal use is about 46 million bales, or about 41% of world production. U.S. exports were about 14.75 million bales, or a little more, or nearly 14% of world production based on the USDA estimates. China is a major export destination for U.S. production. It's the circular relationship between subsidies in the United States, production in the United States, U.S. exports, and then China production and China stockpiling and China utilization and exports of finished cotton products. That circular flow is part of the explanation for this gigantic move in price. So we're expecting better ending stocks in 2012, not this year, when global plantings finally accumulate and should improve the world stock-to-use ratio based on what we think is going to happen. Until then, we do expect prices are going to remain under unusual pressure, especially since we expect Texas is going to produce subnormal crop yields due to the extreme drought in that area. So let's take a look at a couple of technical charts of where cotton has been trending based on the July 2011 contract. You can see in the upper right-hand corner that the price momentum has broken, and the technical chart indicates that the move towards $2.20 a pound has been broken, with the chart indicating some support somewhere towards about $1.70. The July contract has been pricing a little bit below that, but I think it has had difficulty pricing below $1.60, which is unbelievable. If we think about what the apparel makers have been saying about where they were hedged on per pound prices, most of them were hedged at around $1.70 to $1.85, excuse me, rather about 70 cents to about 85 cents per pound, which is about half of where the spot market has been more recently. So the prices are going to get passed through because there is no longer any other way of mitigating it. Looking at the next slide, we can see some of the support levels for cotton prices in the spot market. The lower range has been drifting up more recently. Previously, we had expected a lower range support at about $1.05. The strongest bottom line support would be at about $1.15, with the more reliable support level, unfortunately, at about $1.65, which is close to where we are. Recently, we published an update on what we see going on in the cotton markets and in the apparel industry and retailing, and we believe that the trend for cotton prices in the spot market is going to be between $1.70 and $1.90 into the late summer, which is, again, absolutely extraordinary. On the next slide, the impact of Texas in the United States production cannot be understated. It is enormous. They're almost one half of all plantings, based on the latest USDA estimates, which came out just a few weeks ago. So at about 48.7%. There have been increases in plantings in Georgia, North Carolina, Louisiana. Texas, on a percentage change basis, is increasing its plantings, but on a on a number of acres relative to how much is already going on, it's not necessarily big enough to change the picture. And now that you see the Texas picture of their role in U.S. production, take a look at the entire map of the drought intensity in the United States. This is caused by the La Nina effect, which is the cooler subsurface water temperatures in the Pacific Ocean, and that unfortunately is persisting. A couple of months ago, it sounded like the La Nina effect might be breaking up, and then it was contradicted by more recent meteorological insights, which suggest that it is persisting. Cotton spiked up immediately on that news and has been coming down since that time, but of course is finding resistance at about $1.60 and $1.65. You can see the entire cotton belt, especially Texas, is in a terrible drought situation. This in turn has led to the fires, which are now another threat to Texas crop production. The fires in Texas started out affecting about 200,000 acres. It is not specific to whether those are affecting crops, which types of crops. However, the latest news on the fires suggests that the amount of area is well over 1 million acres are burning, and that means that it is very likely that you could have some material impact on cotton crop production in Texas. So the outlook for yield on cotton crops and abandonment of crops later this year in Texas is significant. Therefore, U.S. production is going to be below really any prevailing estimates, and that should push prices higher later this year. This is unfortunately a very bearish situation from a yield and production perspective, and bullish for prices in the spot market. So taking a look at one more chart, we have tried to get a way of having an intuition about what's the relationship of the spot cotton market, those really extraordinary prices, on the retailing industry. So we simply took spot cotton as a percentage of the S&P retail index. This is not a scientific way of matching apples to apples, but it is the way of beginning the conversation. You can see from the chart that we went way out of any historical alignment of the relationship of cotton to earnings in the industry. So this means that a few things have to happen, and some of them will happen. That means that either cotton prices will come down, pushed down by some sort of a change in demand, or pushed down by some sort of a natural evolution in the spot market, or retailing industry earnings will go quite a bit higher, or earnings could come down and the spot market could stay kind of the way it is. You can see that the ratio is already starting to come down, but the basic effect suggests to us that unfortunately late this year we will start to see evidence of some erosion on earnings in the industry. Not all of it, obviously, but we should start to see some effect from the higher cotton prices on a bunch of retailer and apparel industry earnings late this year. This is a slow process. We doubt that it would show up until Q3 at the least, and Q4 certainly. So to summarize this, rising costs of cotton and chemicals because of the high cost of crude oil and derived products from crude seem to be infecting the cost of goods sold in the entire apparel industry globally. Historical hedged prices have been trending around 75 cents on average per pound. Therefore, the newer hedging prices for the upcoming quarters, after those hedges have fully expired, these would vastly exceed historical prices paid. So it's a very big problem. Prices will get passed through to the consumer. There's two waves that we expect. The first one is in back-to-school apparel, and then the full-blown wave will be in September and October, affecting pretty much all of apparel, with the biggest price adjustments that the apparel industry has seen at retail in about 20 years. We've studied which types of consumers and which types of retailers have more vulnerability, and it does vary significantly in some cases, and you're welcome to ask me when we start to do the Q&A where I think the sensitivities would be and which retailers are in a better position. Higher risks to earnings could occur in seasonal, fashion-sensitive concepts where end-of-period markdowns typically trigger higher risks of markdown expenses. Some consumers would be waiting for those end-of-season markdowns and buy more volume of those, letting some of the full markup stuff kind of hang on the shelf and on the T-rack a little bit too long. Higher markdown expenses, along with the higher cost of goods, would hurt earnings in the sector later this year. So that's the basic thesis, and that, of course, is derived from the conversation that comes from the chart that we just saw. So I'm going to hand it back to Tanya, or Tanya, if you know how to take the controls back, that would be even better.
Thanks very much, Richard, and thank you, Nancy. I'm going to go ahead and make myself the presenter, and give me just a second. All right, that was great. Thank you both very much. We're going to go ahead and move now into the perspective portion of our webcast. So just a reminder, I'm going to be asking some questions, and each of our panelists is going to have 2 minutes apiece to provide responses. And yes, I will be timing them to make sure we keep things going along. So let's go ahead and get into the first question. So our first question is, farmers are expected to expand cotton crops in all producing areas, but how long will it take supply to change direction of pricing? Nancy, why don't we go ahead and start with you?
Okay. Basically, based upon the market dynamics of supply and demand, this market correction will materialize, but the question obviously is when. Economic forecasts are for 2012, 2013. Prices will show an easing. But what we need to understand is it takes time to adjust. You just can't order up more cotton. There's a one-year growing season, and higher cotton prices are not exactly making the farmers plant, even though they've increased their acreage about 15%, but you really have to look at the fact that there are other crops that are also vying for positions, soybean, corn, and wheat. On average, they're up about 1 is 64%. I mean, there's high increases in everything, and as Richard said before, it's expensive to plant cotton. But I think if we really look at, as we get into probably the third quarter of 2012 into 2013, we're looking at some price easing, but the one thing we do know is that the volatility of this market is the likes of which we've never seen.
Great. Thank you, Nancy. Richard, do you have anything to add?
The part of the question, how long will it take supply to change direction of pricing? And the answer is, unfortunately, 2012. This year is lost. So the best hopes that we have for supply, looking at supply only, is that many countries, because they see so much pricing power in the product, they have increased plantings. India's been, busy on this for quite a bit. Brazil has jumped all over it. So you're starting to see it in other countries. And we're even seeing it changing in certain states in the United States that have increased their plantings, but they're colliding with the drought conditions like Georgia and North Carolina. 2012, if La Nina eases up, and then some of those crops will finally start to kick in because of the cycle of things getting locked in and just the nature of the multi-month supply chain regarding production of finished goods intended for shipment to different consumer markets on the planet. It really is going to take much longer than this to really move the needle. So hopefully 2012, contingent upon developments with La Nina.
Great. Thank you both. We're going to go ahead and go on to our next question then. Retailers and suppliers are developing and producing merchandise for back to school and holiday right now. How does cotton inflation impact different companies in different ways? Richard, why don't we start with you?
Basically, where you have basic products, staples like Hanes brands, Fruit of the Loom, some athletic activewear, which tends to sometimes have very simple cotton-based constructions. Some of that stuff tends to be simpler, and the purchase order agreement, this is the key concept, is what is the structure of the purchase order agreement. And when you're doing business with Walmart and Target, to use those two examples especially, the purchase order agreement, especially with Walmart, is simpler than it is in seasonal fashion-sensitive goods where there are variances in what the product will look like from season to season. So I would say that where you have staples and basics and where the purchase orders are coming from those types of retailers, things are a little bit easier, and the cotton inflation impact, we believe, is less. We're more concerned right now with the complex set of influences that would come from higher cost of goods sold in fashion-sensitive things sold into markets where some of the end consumers are going to hesitate a little bit when they see those price increases at the end of the year. That will create more pressure on the seasonality and the timing of sell-through, at what price, at what margin, and in what volume. And software is how you solve all of that. Point of sale data will start to pick up the pattern, and then the collaborative nature of the relationship between suppliers, brands, and retailers, hopefully they'll exchange enough information to take the evidence from that little fluctuation in point of sale and say, this is how we modify the product, the pricing, and the volume, and the styles. You're really going to start to see a narrowing of SKUs as this continues to unfold, and that could impact the variety of things on the shelf early next year. But basically, I'd be a little bit more concerned about things that have a seasonality and a fashion component. some of the things that are coming out of, just to use a few names theoretically, Phillips Van Heusen, Carter's, those are some of them, Jones Apparel Group, where there might be a little bit more vulnerability. Ironically, those that are selling staples, I think the situation is a little simpler, and we can certainly discuss it a little further.
Great, thank you, Richard. Nancy, do you want to go right ahead?
Oh yeah, sure. I mean, basically, Richard has said it. I think what's happened is that as everybody was looking at shorter lead times and being able to react to fashion cycles faster, the impact of what's going on in the price pressures of the market, and really you have two issues. You have a fabric shortage issue, and you also have a production issue where the countries themselves, really have a lot of their production is going for local consumption. So I really think that it's margin, that regardless of what segmentation of the market you're in, there's huge margin pressures. I believe that the fashion retailers and the junior chains have a better chance of being able to pass on those prices to their consumer because it is fashion. They've got a lot of new technologies going on in fabrication. They're coming, because the price is narrowing between some of the tencels and the rayons. So alternate fabrics have helped them tremendously. I also think that the price-sensitive commodities, being the basic cotton T-shirt, for the opening price retailers is going to be difficult. Even though they may have bigger pencils to buy, the basic price of cotton is up, and you can't take that out of the equation because prices have been passed on to the retailers and to the mills. It's real. So I think there's a lot of caution where people are looking for fashion. They're looking for shorter lead times, faster cycles, looking at committing fabrications earlier but cutting it later so that they could keep the supply going. I think it's easier for a fashion retailer, for a department store, for a junior apparel than it is for some of the big boxes, whether they be the Dollar Generals, the dollar stores, or the Walmarts. I still think it's going to have huge pressure for them on pricing because with prices up and production costs up, you really have to take it out of the garment. So I think it's cautious optimism for everybody.
Great. That was great. Thank you both. Now we're going to go into our next question. What is the influence of the U.S. dollar for commodity prices? Nancy, why don't you kick things off?
Well, basically, as we're looking at the renminbi, or the China currency, is the biggest issue. Most of the prices that have been quoted at an appreciation of the yen at about 5 to 8%. So they're already buried into the cost if you're looking at the goods that have been quoted and priced. I think that the dollar will continue to fluctuate, especially not only just about China, but there's huge pressure of the Thai baht and Brazil. We really devalue tremendously against that, and I think that's a major issue for us, especially as we go into the latter part of 2011, early into 2012, and further. That we're going to see greater appreciation on China's currency against the dollar. The dollar has not strengthened, and I don't really see it. I don't think the economists see it strengthening in the near term. And China is really appreciating continually. The question, I think, in everybody's mind is how high is up? But I can tell you 5 to 8% has been baked into the prices right now. Thank you.
Great. Thanks, Nancy. Go ahead, Richard.
The dollar weakness is significant. It is especially significant in commodities which do not have a big climate component. Crude oil is very sensitive to currencies. Cotton is very interesting, and this whole price phenomenon with cotton has been extraordinary, partially because it's not as sensitive to the dollar as crude oil would be, because of the climate influence. Obviously, if it's very dry outside, it really doesn't have any impact or negligible impact really on anything that's going on with metals and with liquid fuels from fossil fuels. But anything to do with grains, and then cotton especially, it's really, really sensitive to climate. So the dollar is another influence, and we are seeing the persistent weakness in the dollar There's very little in U.S. policy that seems to be set up to change it. There are complex reasons why we believe the Federal Reserve and the Treasury maintain this policy. It's because, in our view, that the planet has become so small and it is no longer possible to act unilaterally on something domestically because of the repercussions in another realm of the planet where trade would be disrupted, where inflation would get triggered even greater, even though there's, now a significant amount of inflation over in China. But I think they're very hesitant in the United States about doing something about the dollar because they're concerned about doing something that would weaken the euro, especially at a time that the Eurozone absolutely must maintain the strength of its currency in association with a refunding of the banking system over there because of the sovereign debt and other banking-related problems in the Eurozone. So we've gotten into this very complicated ecology where one part can't really do much separately from the others. The dollar index recently has been threatening the 73 area, which is extremely low. That'll certainly push gasoline prices higher because it will push crude oil prices higher. The problem for our industry is that it pushes diesel fuel prices significantly higher, and commerce is pretty good. The recovery is still on pretty firm ground, and the demand for diesel fuel is pretty decent. So not only do we have cost of goods sold from materials and labor and ordinary types of inputs, but now we're getting surcharges from diesel fuel price increases thrown into the mix. So the impact on back to school this summer, prices will go up because of fuel surcharges, because of diesel fuel, and that will continue late into the summer and will become a more permanent feature late into the year. So we've got a big problem with the connection between the dollar, diesel fuel prices, adding another layer on top of the cost of goods sold problem coming from the cotton price increase. So that's not a good situation, but we are getting closer to an interim correction in the dollar, somewhere closer towards 72 on the dollar index. We would start to see a correction, and then it would bounce up a little bit.
Wow, very interesting. Thanks very much, Richard. We're going to go ahead and go on to our next question. What other commodities are volatile, and will they be impacted in the next 6, 12 to 18 months? Nancy, why don't you go ahead and start?
Okay, basically, I'm just focusing on the apparel industry because Richard does a great job on the balance of it. As we look at, and we've witnessed really the wool and polyester prices continue to increase, and we see that continuing as well. There really is no reason that anything is going to level off, over the next year. I think that the polyester prices are a direct relationship of what's going on with petroleum. Everybody was really hedging and hoping that poly would hold and not continue to deviate as much as cotton and wool has right now. We don't see that happening. A lot of fabrications have moved to cotton blends, whether it be cotton flax, cotton poly, cotton nylon, cotton acrylic. So there's a lot of synthetic blends moving in with cotton, as 100% cotton has still gotten a little expensive. But we see a harder situation as we go forward because of the petroleum-based yarns having an impact of what's going on with petroleum. So that's a little bit scary for us as the industry as we look forward. The wool prices have had a huge impact, as we all know, on cashmere and on any of the wool commodities. So, I don't think we're going to see anything level. I think we're in a volatile market. I think anything that we know is that it's totally unpredictable, and the dynamics are greater and faster than we've ever seen before because the economies in the BRIC nations are growing. So you're feeding supply not only just to the U.S., but it's on a global basis, and BRIC is outpacing us right now. So you've got a huge, huge pressure on all commodities. Thank you.
Great. Thanks, Nancy. Richard, I'd love to hear your perspective.
Yes. Very similar to what Nancy is saying. Chemicals and dyes and inks, anything that's petroleum derived, unfortunately is going to continue to see significant pricing pressure as well. So it's not a pretty picture. This is a very unusual situation where we've got pervasive pricing pressures. And I'll mention something about Vietnam and China. There has been the attempt to find sources of labor costs per unit that could be a little bit lower than what they are in China. And Vietnam has been one of those destinations, especially in popularly priced footwear, not in higher priced footwear. That's still primarily Europe and a little bit of South America. But Vietnam has become a place where apparel and footwear have tried to find a place where they can find lower costs of unit labor. And Vietnam has been pretty helpful with that. But there are structural limitations over there in Vietnam that have to do with the electrical grid, that have to do with them buying some of the pre-assembled components from China, cross-border trade, and then they have to finish it up, and some of it might go directly from Vietnam to containers back to the United States. But then a lot of things wind up going back over the border into China for destination and freight on board at the ports to the containers back to the United States. So all of that conversation about that, you're talking about things moving around. That's cost of freight, and if the cost of fuel is higher, then it impacts that as well. So at this point, I would say there's not much of an escape, and therefore one of the risks that's coming to mind is the variety of stuff that we have enjoyed seeing on the shelf. In the moderate market, we might start to see a narrowing of the SKUs certainly next year. I don't think we're going to see it that much this year, a little bit late in the year, but definitely there's a risk to variety in the moderate market next year because the commodity price inflation is pervasive enough, and there's really not much of an escape. So we're not seeing anything in the future. 6, 12, and 18 months is what's indicated here. 6 months from now, commodity inflation will remain strong. 12 months from now, it will very likely continue to be higher than historically comfortable. 18 months from now, it's more difficult to forecast, so I'm going to stay away from that one. But 12 months really puts a lot of 2012 at risk as well.
Great. Thanks, Richard.
I don't know why you said great. That's all bad news.
Yeah, I know. I'm trying to remain cheerful here. So this is near and dear to us. How can technology mitigate the impact of commodity shortages, in your opinion? How can it mitigate and calculate the impact of inflation? Keep going, Richard.
Well, this is the solution. And, you know, if we had circumstances like this 20 years ago, first of all, we would have a lot more inflation. Companies would be borrowing more in order to pay for part of the inflation. And you would have more of the classical inflation credit scenario that was typical in the 1970s and early 1980s. And then as technology finally started to make its way into everything in the late 1980s, the back of that system was broken, and now we live in a new paradigm. And of course, the capabilities of software today are unbelievable compared to even 5 to 7 years ago. And it's only getting stronger, you know, every couple of years. It's much, much stronger. So the technology tools that we can think about are geospatial overlays to map out where we see changes in things, looking at it from the supplier perspective globally. Who has better pricing? Where are they located? What are their supplies? Where are they pulling product from? The capability of doing that is enormous. When I mentioned the thing about the SKUs, the variety of merchandise on the shelf starting to get narrowed, software will start to analyze little fluctuations in the timing of sell-through, what time of the day, which markdown, which promotion, which combination of promotions the consumer has elected to use, and that will tell the industry to optimize those products and to choose certain kinds of promotional techniques in order to increase volume effectively, and that helps to pay for the higher cost of goods sold. So technology, thinking of it in terms of point of sale analysis through the hardware, and then what kind of software is that running, The retailer can be enormously helpful from that side. And then the brands and the suppliers can enjoy the influence of technology by looking for all kinds of variances in many different aspects of production, and especially the capability of looking at efficiencies based on location. How far does it really does it take to get product from point A to point B, and what kind of fuel efficiency is required to do that? So the capabilities of the industry of becoming synchronized for a coherent effectiveness where both the shippers, the suppliers and the brands and the retailers can all come together. And then you've got, now you've got consumer input, which is growing at a pretty fast clip, and that provides even more information about consumer response. So there are many different points, and this really changes the impact of this. If this were 20 years ago, the situation would be just terrible, and prices would actually go up quite a bit more. But fortunately, and this is the good part of the story, is that technology, software and hardware, and this massive data convergence, which continues to unfold and revolutionize everything, it's preventing this situation from spinning out of control. It is manageable. It's negative from a price perspective because we're not used to this, and yet software and hardware can really mitigate the impact. So that's really a favorable side of the story.
Great. Why don't you go ahead, Nancy?
Okay. I mean, Richard said it beautifully. Just one other segue into it, because I do agree POS is critical to analyze markdowns so that you take them faster and could basically protect whatever margins you have. But I'm also looking at it as how do you manage your markdowns, as the cost factors need to be analyzed much more closely than they've done before. Product engineering is critical, and understanding how design can analyze raw material costing to gain greater transparency throughout the supply chain is, I think, a mandate in today's world as we look at all the process flows. Models need to be created so that as you plan your assortments and you look at your flow of merchandise and you're looking at your mix of costing in order to meet the margin requirements by category, by department, it's more important that your business is supported by technology. I think technology will separate the winners and the losers. I really think that it's critical to your business today, especially as business is more difficult. Many people focused on, getting costs out of the supply chains over the past 2 years. We were in such a deflationary spiral, so all of a sudden to have this windstorm upon us, you really have to rely upon technology to be able to analyze your business, look at it from really, I think, from design through delivery and then to the storefront. Where are all of the stop gaps in the way? How do I how do I take my business forward? How do I move it forward? How do I support it? And technology is the driver, I think, for the difference of your margin. Thank you.
Great. Thanks very much, Nancy. We appreciate that. We're going to go ahead and go on to the next slide here. Now, what are 5 simple tactics each of you can give for retailers and suppliers, what they can do to make a difference now? Richard, we'll start with you.
Number 1, analyze the frequency of sell-through of product that has the highest cotton component in its overall construction. So the first thing is, I guess there's 2 things here, but the first thing is to analyze what in my total package of SKUs has the greatest amount of cotton, and then I need to overanalyze how that product is going to sell through. And I mean as granular as you can get it. What time of the day, what promotions were you running, what 9-digit zip code, or I think that's what it is, or get it as geospatially as specific as possible. Get consumer feedback, something to do with that specific product. Nail down the behavior of your cotton-intensive products by overanalyzing the many different data attributes at sell-through. Time of day, day of week, everything you can get. Start with that. That's the first thing that comes to mind. And I guess I'll send it back to Nancy to figure out a couple more.
Okay. Thank you. I mean, I think there's a few things I'd like to look at. First is innovation, innovation, innovation. I think it moves the business forward. I think that a lot of people don't spend as much time as they really should on innovation of product, innovation of design, innovation of fabric, and also of processes, you know, supported by technology as you really look to invest in the future. I think improved analytics of the supply chain, looking at country considerations in order to mitigate risks. I don't know that a lot of people really spend the time strategically looking at the supply chain. People jump for pricing, and that's always been something that I've watched closely with all of the people that I've managed and the countries and factories I've managed. So it's really analyzing your supply chain, looking at what are the pros and cons by country, lead time, quality, price, value. Price isn't the only equation. Quality has to come into play. I also think that people are not nurturing their strategic supplier relationships. There has to be greater collaboration today than ever on your suppliers, not only just your manufacturers, but on the fabric suppliers, your trim suppliers, your who does your paper bags, who does the poly bags. I mean, you really have to build relationships for the long term with your suppliers. I think you have to learn to engineer savings in the product development cycle. I don't know that all the designers really understand what goes into design integrity, what is the differences as you cost the garment between different types of construction, fabrications, how do they drape, how do they cut. I don't know that there's enough focus really put on the designers with the technical people to actually engineer savings, which you could do very easily. You have to leverage raw material across divisions. I mean, from my own experience dealing with, as a consulting or as dealing with my own staff, it's really looking at fabric across divisions. It's looking at supply trims across divisions and being able to narrow the suppliers you do the business with and being able to negotiate better price because you've got economies of scale. You know, I think it's analyzing every segment of the supply chain, you know, whether it be your logistics suppliers, you know, whether it be your consolidators, and really bridging the gaps and using technology as the driver to make informed decisions. Thank you.
That's great. Thanks, Nancy. Richard, is there anything else you'd like to add?
I love what Nancy said about innovation, and I think once you get back a little bit above the moderate market, it gets a lot easier to do that, and that's a big technique that should come into focus. Now, there's a cost component of innovation. However, if you really start to create a freshness of product more frequently and add certain characteristics to the product where the attractiveness of it and the freshness of it overrides that higher price, which is what's going to happen anyway, you can really start to appeal to the consumer, because once you get above the moderate market, people are looking for freshness of ideas to a degree anyway. So if you can do that more frequently, then you have to start to analyze its effectiveness. How did it go? But I think that's a great point that she made about the product innovation cycle. You've got that in consumer electronics, but it's definitely an opportunity to do that as a tactic in better priced goods, to experiment with a more frequent obsolescence, replacement, and innovation in product in order to really make the consumer forget about the price. It's a great point, and I think that that's something that can make a difference.
Great. Anything else either of you would like to add, or do you think we can move on to our last and final question?
I think we're starting to feel more optimistic now.
I think we're good.
Okay. So now we're at the question that everybody has been waiting for, and that is, we're very curious to hear both of your perspectives on what will the prices of cotton be in December of 2011 and then in June of 2012. So Nancy, why don't you start us off?
Okay. Basically, we all know that for December contracts, they close at $1.32. So December, $1.32 is the close of the contracts. Most of the cotton that has been booked, and a lot of it, as we said before, has been booked, has really been booked at an average of about $1.50. with some contracts going up to scarily $240. Right now, Uzbekistan, which has always been the cheapest place you ever could buy cotton, is at $233. So they're way above anybody, which none of us could really figure out what's going on. But you know, it's if anything, it's unpredictable. But you know, we're looking at the contract price of $1.32 in December. Will that be the actual price on the market price? You know, I'm looking probably closer to $1.50 to $1.80. As we look at mid-2012, which is the next benchmark you're looking at contracts right now for $1.21. That doesn't mean that's where it's going to be sold, but that's what the contract price is for May. Then we skip to July, and it goes to $1.14. So the contract prices that are out there are lower than my feeling of actually where the fabric and the contracts will be written. So, you know, my guess right now as I look at December, I'm going to say $1.50 to $1.80. As I look at 2012, I'm going to basically probably maintain that. Do I think they could go higher? Yes. I think that there is a lot of unknown. You know, as Richard has spoken to, the volatility of what's going on when, you know, almost half of the cotton that comes from the U.S. is predicated on a good crop in Texas. They've had some really great crop yields over the past couple of years. Is a big question mark. 90% of the cotton that is produced in the northern hemisphere, which is more predicated on weather. The balance of it is the southern hemisphere, and that's a reverse season that comes in now. That crop on the market from Australia and Brazil is right now at $240. So I think that while I've given you my prediction, I will qualify it by saying anything is possible when your dependency of 90% of your crop is coming out of the weather-related northern hemisphere, and anything is possible. So, Richard, I turn it over to you.
Thanks, Nancy. The general feeling about prices, December 2011, the price would gravitate in the U.S. towards about $1.70, and in June 2012, it would trend closer to $1.35 per pound. Those are U.S. Exchange prices. When you're hearing these absolutely gigantic numbers, $2.40 overseas, that's a translation back into U.S. dollars. So the weaker the dollar, the higher that number goes. So what was $2.40 somewhere else, if the dollar goes down a little bit more, then that number goes from $2.40 a pound to $2.45, $2.47. And it's bad news because most settlements in commodities globally are done in U.S. dollars. So that's part of the reason why it's going to be difficult for prices to come back down to those historical numbers, which would be in the 70-ish cents per pound area, which is a good price. And then, of course, if it would come down into like 55 to 60 cents a pound in U.S. Domestic spot markets, that would be lovely. But with the dollar being what it has become and the lack of evidence that the policy would reverse that, and the implications for global trade and inflation would not be good if we forced the dollar to be very strong. Therefore, the outlook for prices is significantly higher than historical.
Great, great. Thank you both. So now we're going to go ahead and just keep things rolling along. We're going to have it open up our open question and answer session. Once again, if you are interested in asking a question to one of our experts, please use the question box that's on the right of your screen. And we've had a few coming in, so if you give us just a second, we're going to go through them and see which one we can get to first. Now, we've got one question that came in is there a time later this year when the cotton supply will be unavailable even at higher prices?
I would let Nancy answer that.
Well, right now there is no cotton, so you know I think you're experiencing it. As I look at the next cycle, the next crop that'll be harvested, you know we're really I mean, all of us are optimistic, and we're just saying that we're not going to have what we had before between Pakistan and India changing their mind every 5 minutes, so that we should see more of a level set or flow of cotton on historical levels than we've seen before. I will qualify it by saying if Texas is devastated, I mean, and we don't know. I mean, Richard pointed that out very well, and I don't know. And we've asked around because, I mean, no one wants to give a prediction this early until they're 100% sure. But that could have a huge, huge impact. I mean, you know, the U.S. is number 3 in export of cotton. You know, as you look at India holding more cotton for their own local market, you know, we have no place to go. There is no place right now in the world that if we get impacted, even 10%, that you've got a 10% flow of cotton any place to level set that supply chain. So, you know, we're optimistic that it will be historical flow, so we won't be out of cotton like we currently are experiencing right now. And that's my best guess. Richard, do you have anything to add?
It's pretty close to that. Yeah, the Texas thing, I'm concerned about the number of acres that are burning, and I don't have enough visibility yet where they're burning, whether they're, you know, actually starting to threaten specific crop locations. And, you know, I would agree with what Nancy said about all of the above.
Great. We'll go on to our next question. How do you think the crisis, the current cotton crisis, has affected retailers' private label development efforts?
Why don't you just jump in? I mean, I think that it's lengthened the supply chain. I mean, I think the biggest impact right now to private label or brand, it really doesn't matter. It's the same development process that you go through, you know, whether it's your own store private label or whether it's a branded product from a manufacturer, is that, you know, as we were dealing with shortened supply chain, shortened timelines, being able to react to the consumer in a shortened period of time, going from, you know, cycle times that we're looking at 30 days. That's had a huge, huge impact on their ability to maximize the consumer reaction as she's voting every day and walking into the store and developing newness and reacting to trends. I do believe that it's made people smarter. It's made them be a lot more analytical about the business they've done, really spend more time in looking at line reviews and being able to talk us through and pulling management into more of the executive decisions of what they've done. I think it's narrowed the assortment to a degree, as Richard said before, less SKUs, much more if they've got locations in the southern and northern hemisphere to try to do more testing so that you could test market product to understand better the consumer reaction to an item or a category or classification. You know, but it's had a huge impact on everybody on really reduction of cycle time. And the fact that we are in a fashion cycle has exacerbated even more because you're constantly looking for newness in a world marketplace that has been impacted by prices. It's not just the U.S., it's globally. You know, but I go back to, you know, Zara, and I'll go back to H&M because you really have to go back to the fact that they believe in design integrity. So there's a lot more focus on innovation and designers on new product and new fabric technology and innovation, and they're delivering a lot to market and they're winning. So I think it's opened our eyes. It's not, you know, so much I call it a front and a back. You know, it's not as easy as it was. You have to really spend your time and analyzing what you're doing and bringing more people in. It's got to be a lot more collaborative. Richard, do you have anything?
I think the question about private label, this is coming from probably an intuition about something very big. So if we go back 25 years ago, private label starts to go through its next evolution and really starts to take on a bigger life. And if you look at department stores and the percentage of product that's private label, that means that department stores, which is a multi-brand, multi-product concept, has become much more directly exposed to the cotton cost of goods problem than would have been the case 15 years ago. So it kind of changes the game a little bit. So the search for private label as a solution to just-in-time, to volume efficiency, to more flexibility on inventory management, calling in goods more closely to when you need them, easier cancellation situations, just taking out some of the complexity of the relationship with the third-party supplier, some of the frustrations that department stores had with suppliers and supplier ability to really be shelf ready and in compliance with all the different carton and ready to shelf kind of things. You can see that this search for those solutions is now colliding with the higher cost of goods phenomenon, so they're fully exposed to it now. So, okay, it's logical that an entirely branded thing like Old Navy has direct exposure, but now other concepts are significantly exposed as well. So the department stores, just to name that concept, they're definitely not protected by the barrier of the unaffiliated third-party supplier anymore, so they're fully exposed.
Great. We're going to keep things going to our next question because they are coming in fast and furious. What should we expect to see for margins in the retail industry going forward?
I don't know, Rich, you want to take a stab at that?
Yeah, I think that what we're seeing is stability in margins, a little bit more in staples in some place like Walmart, and I think that there's I'm a little bit more concerned about the margin story in the moderate to slightly better moderate market, but not better. It's in that little territory of the moderate market to some price points at the higher end of the moderate market. I'm a little bit more concerned about margin in that area, and I don't have a number to aggregate, just what's the general historical number. I would just say that I have more concerns about the margin there because of seasonality, fashion, and the type of consumer. We've analyzed recently the income profiles of consumers, the shoppers of a bunch of different retailers, and there are big differences in those profiles, and that tells me a little bit about margin risk to certain retailers, and I think it varies from case to case. I would say that I have more of a concern about the margin stability in the moderate market right now.
And to jump in on that, I will say that I do believe that the margin impact for the fourth quarter is going to be a little bit greater than we had originally envisioned it, or some of the street has believed it. It's probably 1 to 2%, and that's because a lot of the goods that ended up increasing in pricing came late in the pricing game. So a lot of the goods that was really predicated to come into the store was priced, prices increased, and I'm not sure that it was really baked into the margins for the fourth quarter. So I'm going to basically say I think there's about a 1 to 2% risk in the margins from what I've seen coming out of the Far East and working with some of the retailers with some of their cost of goods coming through.
Great. So we're very cognizant of people's time, so we're going to go ahead and go on to our final slide. And just wanted to let you know, if we didn't get to your question, we will definitely be following up with you. But to learn more about how TradeStone's merchandise lifecycle management technology can help mitigate and project the impact of fluctuating commodity prices, please contact us at visit our website at any of these addresses, or feel free to call us at 978-281-3723. I'll say that again. That's 978-281-3723. There's a contact us form on our website available as well, and you can feel free to ask for myself. Once again, my name is Tanya Stockbridge. We'd love to hear from you. We appreciate everybody's time today, and thank you, everybody, for joining.
Thanks. It was great to be here.
Yeah, thank you, everybody, and thanks, Tanya. Thanks for the invitation. Thanks, Richard.
Bye.